as a review here, last time we talked about the differences between absorption costing and variable costing, right? So the absorption costing is just the what we learned traditionally, right? So in absorption costing, we considered every cost related to the production process as the product cost, which includes the fixed overhead, right? But in the variable costing, we do not consider the fixed overhead as the product cost, and we put it in the period cost. And so, as you can see, under the variable costing, the product costs are all variable costs, right? So that's why the variable costing gets the name variable, right? Because the product costs are all variable costs. So if we use the absorption costing, the income statement that we prepare follows GAAP. Right, so basically, we need to calculate the cost of goods sold, and then calculate the gross profit, and take the S&A from the gross profit to get the operating income. But if we use the variable costing, it's not required by GAAP because it's for the internal users, right? For the managers to make decisions. So the format of the income statement follows the contribution margin income statement, right? So we need to subtract all the variable costs from the revenue to get the contribution margin, and then subtract all the fixed costs from it to get the operating income, right? And the reason why managers use this version of income statement is because they want to classify the costs into the ones that they can control in the short term and the ones they cannot control in the short term, right? So basically, all the variable costs are controllable in the short term. For example, the direct material, right? You can change the direct material cost by, let's say, purchasing more expensive materials or purchasing less amount of direct material, right? So those costs can be controlled in the short term. But for the fixed costs, sometimes, most of the time, you cannot control it within, let's say, 1 year. For example, if you rent your factory, right? Usually we sign a contract for 1 year, and then that's not controllable within this time. So that's why the managers, they have the variable costing version of the income statement. Okay. And last time we also mentioned the comparison between the operating income from the absorption costing and the variable costing, right? And so I think we already mentioned the situation where the units produced are equal to the units sold, right? So who can tell us what happened to the operating income under the first situation, where the units produced are equal to the units sold? So the operating income from the absorption costing is equal to or greater than or smaller than the operating income from the variable costing. So what's the relationship? Yes, they're the same. They are the same, right? Do you guys still remember? I think everyone feels tired after the spring break, right? Mm-hmm. Yeah, same for me. I think we need some time to adjust. Yes. While you are closing, it doesn't mean that we are going to, we still have work to do, right? So just to give you a review, right? Last time, this is the example we gave, right? So in this example, this firm basically produced 1,000 units of products and sold 1,000 units as well, right? And given the cost information, I asked you to calculate the unit product cost under the variable costing and the absorption costing, right? So under the absorption costing, if we want to calculate the unit product cost, we are going to consider the fixed overhead as part of the product cost, right? So here on the 1, 2, 3, 4, on the fourth row, right? So this one is calculating the unit fixed overhead, right? So because the total overhead is 20,000, right? And we produce or make 1,000 units of product. So we need to divide the total by the units that we make, right? So the unit product fixed overhead is 20, right? And then we just need to sum all those product costs defined by the absorption costing to get the unit product cost or the absorption costing, right? And if we are calculating the unit product cost for the variable costing, the only difference is that we are not going to consider the fixed overhead as the product cost, right? Because under the variable costing, only the variable part of the manufacturing costs are considered as the product cost, right? So do you guys still remember this part? Right? And after we calculated the unit product cost, we then go to calculate the operating income. Right? So if we use the absorption costing method, we just need to follow the traditional income statement to calculate the operating income. Right? So we have the sales revenue, cost of goods sold, right? So this one, because the cost of goods sold is just the cost of the products that you sold, right? So because we sold 1,000 units, and each unit has the cost of $43, right? That's from the absorption costing. So that's the cost of goods sold, and then we subtract all the S&A, right? Both the fixed part and the variable part. So the operating income is 3,750. And if we calculate the operating income under the variable costing, we just need to follow the contribution margin format, right? So we first subtract all the variable costs from the revenue, right? And then subtract all the fixed costs. And the operating income is the same as the one that we got from the absorption costing, right? So the conclusion is that when we make the same amount of units as what we sell, the operating income is the same under different costing methods. So this is the first step of our analysis, right? And things will become more complicated when the relationship changes. So now let's look at when the units produced are greater than the units sold. Okay, so my question is, so in October, right, we made the same amount as what we sold. So, and also in October, we do not have any beginning inventories, right? So if we have that information, then in November, what's the amount of the beginning balance? So in October, we have 0 beginning balance, right? And the units produced are the same as the units sold, right? So what is the beginning balance in November? 0, right? So the reason is if we sold as many as what we made, then there is no ending balance for October. Right, and the ending balance of October will be transferred as the beginning balance of November. right? So in November, we do not have any beginning balance. Okay, so that's that can be inferred from the information, right? So let's look at the information for November, right? As I already mentioned, there's no beginning balance for November. And in November, this firm basically made 1,250 products, and they sold 1,000 units. Okay, so made 1,250 and sold 1,000. So from this information, what's the ending balance for November? How many units? 250, right? Because you made the amount that you made has extra 250, right? So your ending balance for November is 250 units. Okay, does everyone agree? Right? Okay. And we have the same cost information as in October. So now the question is, okay, now it's your job to calculate the unit product cost under absorption costing and the variable costing. Right? So do it right now. Calculate the unit product cost, right? You need to sum all the components of the product cost, right? And also remember the definition of the product cost under the absorption costing is slightly different from the one under the variable costing, right? And be very careful when you calculate the unit fixed overhead cost. Yeah, I will explain now. Yeah. So to calculate the unit product cost, right, we just need to sum all components of the product cost, right? So under the absorption costing, the components of the product cost, DM, DL, and overhead, all overhead, right, including the variable and the fixed part, right? So for the variable part, the information is given, right? So the direct material per unit is $5, which is given here, right? And the unit direct labor, 15, which is also given. And the unit variable overhead is 3, it's given, right? So the first 3 components of the unit product cost for the under the absorption costing is given. And the difficult part is to calculate the unit fixed overhead, right? So from the previous example, right, the units made are the same with the units sold, right? So in that case, it doesn't matter which. So if I go back, this was our previous example, right? So we made 1,000 and we sold 1,000. Right? And so when we do when we calculate the unit fixed overhead, we need to divide the total amount of the fixed overhead by the units that we make, not the units that we sold, because the overhead is used to make the products, right? And since here they are all 1,000, right? So it doesn't matter which one, like, it matters, but from the number it doesn't matter, right? But if the two numbers are different, you cannot use the 1,000 again, because here we made 1,250, right? So we need to divide the total fixed overhead by the amounts that we made, which is 1,250. And some people divide this total amount by 1,000. It's because you didn't know that you need to divide the total fixed overhead by the amount that you make, right? So here we need to divide that by 1,250. So we will have the unit fixed overhead as $16, right? And then we need to sum all the components up, and then the unit product cost is $39 for the absorption costing. Does that solve your concern? What about
in the previous example, we're still
you always divide the fixed overhead by the amounts that you make. Right? In the previous example, it's 1,000, but here it changed to 1,250. It's bigger, right? So here we do like this, okay? And under the variable costing, it won't change because we do not count the fixed overhead as part of the product cost, right? So it's still 23. So Jerry was right with the help of David, right? So for the absorption costing, right, the difficult part is the unit overhead. But as long as you remember that you need to divide the fixed overhead by the total number of units made, not units sold, then it's easy for you, okay? So now let's do a little comparison, right? So before, in October, where the units made are the same with the units sold, the unit production cost for absorption costing is 43, which is slightly bigger than the 39 in November, right? And the reason is because, so that's the reason why in November the unit production cost is bigger than the one in November.
More units.
Yes, David.
You made more units, so you divided it.
Yes, we made more units, right? So here we are dividing the total fixed overhead by a larger number. So it means that the same amount of fixed overhead is allocated to more products that we made, right? So the unit fixed overhead is lower in November, right? So that makes the unit production cost lower in November. So that's the reason behind it. And now let's practice this clicker question. Okay, so most of you got it, right? Because the unit fixed overhead is decreased because now the fixed overhead is allocated to more products, right? That's the reason. So the next one is some issue in this slide, but this is a slide that we calculate the operating income. Okay, here is the correct one. The operating income under the absorption costing, right? So we have the sales revenue, and now the cost of goods sold is the amount that we sold, 1,000, multiplied by the new unit product cost, which is 39, right? That we just calculated. And then the other procedures are the same. But now the operating income is 7,750, right? So which is bigger than the one that we calculated before, which is 3,000 something, right? So now the reason is because now the cost of goods sold is smaller than before, right? Because now the unit production cost is 39 rather than the 43 that we used previously, right? So if we have a lower value of the cost of goods sold, the operating income will be bigger, right? So that's the reason the operating income when the units produced are bigger than the units sold is greater than the situation when they are equal, right? But if we calculate the operating income under the variable cost, so before I do the calculation, what's your hypothesis? What should be the operating income? So under the variable costing, does the unit production cost change? Does it change, Rafael? The unit production cost in the variable costing, does it change?
Say no.
They are the same,
They're the same.
right? They are the same. So the operating income should also be the same as the one that we calculated in October, right? So if you want to verify, right, you can do all the calculations because everything is the same. So here the operating income is still 3,750, right? Because so when we calculate the variable manufacturing cost, it's still 1,000 multiplied by the 23. The 23 is the unit production cost under the variable costing, right? So the conclusion is that when the units made are greater than goods sold, we are going to have greater operating income under the absorption costing, but the operating income under the variable costing will stay the same. Right? And the reason why the operating income under absorption costing is higher is because the cost of goods sold is smaller than before, right? Because the fixed overhead cost per unit is lower, right? Yes.
Can you go back
This one?
Okay.
It's the same as before, right? You want to compare the one that we made for October with this one. Is
So,
everything? Yes.
The fixed selling and administration has nothing to do with volume.
Yeah, no, it's fixed, right? So no matter how many units you make, the total fixed amount is the same.
Gotcha.
So any questions so far? Here I put Y, right? And I mentioned that because the cost of goods sold under the absorption costing is lower compared to the one in October. But where does the missing part go, right? So remember that we produced 1,250, but we only sold 1,000, right? So we have 250 left, right? So those are the ending balance, right? And for the part that become ending balance, it contains the fixed overhead cost allocated to them, right? So here we put the term, right? We didn't sell what we produced, and the fixed overhead, part of the fixed overhead are left in the inventory of the ending inventory, right? And we give it a term saying that that part of the fixed overhead has been capitalized. Okay. So to understand this, let's look at the value of the ending inventory. So as we said, we will have 250 units left for November, right? So what's the value for that ending balance? Okay, so if we calculate the value of the ending balance under the absorption costing, it's simply the product of the units left, 250, and the unit production cost under the absorption costing, which is 39, right? So the value of the ending balance is 9,750, right? But if we calculate the value of the ending balance under the variable costing, it's just 23 by 250, right? Which is 5,750. So that's the value of the ending inventory. And let's look at another value, okay? So we want to know what's the value of the fixed overhead in the ending inventory. So because we have 250 units left, and also the unit fixed overhead is $16, right? So the value of the fixed overhead left in the ending balance is 4,000, right? And if you observe, the 4,000 is exactly the difference between the value of the ending balance under different costing method. Right, so this means that because under the variable costing, we basically subtract all the costs, right? Especially for the fixed overhead, right? Because the fixed overhead is considered as the period costs, right? So we just subtract it as a whole, right? But under the absorption costing, we consider the fixed overhead as part of the product cost. Right, so we need to calculate the unit fixed overhead to allocate the cost to each product, right? So if we sell less than we produce, it means that part of the fixed overhead will be left in the inventory, and that causes the difference between the operating income under different costing system and also the value of the ending balance under different costing system. Right? So the reason, let me repeat, is because we didn't sell as many as we produced, and part of the overhead, the fixed overhead, are left in the ending inventory being capitalized. Right? So, do you have any question towards this concept here? Because we didn't, so under the absorption costing, right, part of the fixed overhead has been capitalized in the ending inventory. We didn't sell all of them, right? So that's why the operating income under different costing system are different. Amity? You know? Kind of, right?
Yeah.
Okay. I think you will have a better idea if you do some practice, right? Yeah.
Capitalization only happens under the fixed manufacturer overhead?
Yes.
Can you explain what that is one more time? Sorry, capitalization.
So it means that it becomes part of the value of the product, right? Actually, so we assign the cost to the product. This process is called capitalization. Right? So so both B and C are correct. Right? So if you got either of them, you are fine. So basically, we are saying that part of the fixed overhead has been capitalized when we use the absorption costing. And it also means that no fixed overhead was capitalized under variable costing, right? So they are the same thing. But if you get either of them, you are good. So I think that most of you understand the concept, right? So I don't need to spend more time on this. So let's look at the third situation where the units produced are smaller than the units sold. So as we know that in November we have 250 units left as the ending balance, right? So the ending balance of November will be carried over to December as the beginning balance. Right? So now in December we have some beginning balance, right? So that's just the background. So in November, right, we already know that it has 250 beginning balance left from the last month. And in this month, we made less than we sold. Right? So we made 800 units and we sold 1,000. And all the other cost information is the same. So now, same as before, let's calculate the unit product cost under the absorption costing and the variable costing. And I'll give you 2 minutes. So the first, EM per unit, PL per unit, variable overhead per unit should be the same, right? Just given. So we just need to pay attention to the unit fixed overhead. Right? So what she did is to use the total fixed overhead and divide it by 800, right? And 800 is the units we make, right? So that's the correct answer, right? So now the unit production cost under the absorption costing is 48, which is greater than both October and November, right? But for the variable costing, the unit production cost is still the same, right? Because the fixed overhead will not affect the production cost under the absorption costing. Okay, so here the emphasis is that we need to use the units made as the allocation, not the allocation base, as the denominator, right? Because we use that amount of fixed overhead to just make 800 units, right? So that's why we need to use 800 as the denominator to calculate unit fixed overhead. So this is the comparison among the 3 situations, right? So in October, the unit production cost, okay, so the first observation here is that no matter how the situation changes, the unit production cost under the variable costing is the same, right? And the reason is the fixed overhead is not counted as the production cost under the variable costing, so it does not matter, right? So all the unit production cost under the absorption costing stay the same. If we use the absorption costing, the unit production cost changes when the conditions changes, right? So the observation is that compared to the situation where the two units are the same, right? So if we made more than we sold, because the unit fixed overhead will be decreased, right? So the unit production cost under this scenario is the lowest. However, if we produce less than we sold, right? So the fixed overhead is allocated to less amount of products. So the unit fixed cost is the highest, right? So that leads to the highest unit production cost per unit. So here's the clicker question, right? Why did the manufacturing cost per unit or the unit production cost increase in December? Okay, so most of you got it correct, right? Because the fixed overhead per unit increased because now we made less than what we sold, right? So that's the reason. Some people chose B. The total fixed overhead is fixed, right? So if you look at the total amount, it's the same. It stays the same. What increased is the unit fixed overhead. Okay. So here, in December, we said that we had 250 beginning balance left from November, right? And we made 800 units, new units in December, and we sold 1,000 units. So let's imagine that the rule is FIFO, right? First in, first out. So it means that we will sell the units that we just made, right? So we will sell, so among the 1,000 units that we sold, 800 is from what we made in this month, right? So that's the FIFO, first in, first out. And then we drag 200 units from the beginning balance left from November. And this is important because it will impact on the cost of goods sold that we calculate under the absorption costing. And let's see how it will impact. So now I'm going to calculate the cost of goods sold. Okay? So if we are going to sell 800 units that we made in December, right? So the unit production cost that we should use is $48 per unit because that's the production cost per unit we calculated for December, right? So for the 800 units that we sold, the cost of goods sold should be 48 multiplied by 800. Right, so that's the first part of the cost of goods sold. And then the rest of the 200 units are from the November, right? And in November, the cost of the unit production cost is $39, right? So for the 200 units from November, the cost of goods sold is 39 multiplied by the 200. right? So this is why when the rule of first in, first out, or the last in, first out matters, right? Because if you have some balance left from the previous months, and if the unit production cost is different in different months, right? So that will impact on your cost of goods sold in the end. So because if you want to, so imagine that if we use, let's say, LIFO, right, last in, first out, then the cost of goods sold is different because we are going to sell 250 first, and the rest of the 600, no, the rest of the 700, 650 will be from the December. And so that will cause difference. So now the total cost of goods sold is 46,200, right? So yes.
How come we're not factoring in October, just December and November?
Because in October we have no ending balance.
Okay.
Because the 200 units are all from November. Because there's nothing left in October where we make as many as what we sold, right? So that's why here only the November products are left as the beginning balance for December, right? So any questions so far, right? So in this situation, the cost of goods sold contains two components, right? The first component is the one that we made and sold in December, which has the unit production cost of $48. And the rest of the 200 units that we sold are from the beginning balance left from November, right? And that part of the products have the unit production cost of $39, right? So now the cost of goods sold is calculated in this way, okay? So if we, okay, so this is to calculate, okay, so now, can you tell us what's the ending balance for December in terms of units? Right, so we had, let me give you this slide. So we had 250 as the beginning balance, and we made 800, so 1,000, right? So what's the ending balance? 50, right? And if we follow this FIFO rule, where does the 50 units from? From November or December?
December.
From December or November? From November, right? Because we sold everything that we made in December, right? And because for among the 1,000 that we sold, right? So 200 are from November, right? So the rest of the 50 units must be from November. So if we know that information, we can calculate the value of the ending balance, right? Since all the 50 units are from November, the unit production cost that we use should be from the one that we calculated for November, which is 39, right? So now the value of the ending balance for December is calculated in this way, right? Okay. So now if we are going to calculate the operating income under the absorption costing, we just need to follow the routine, right? So the sales revenue, the sales amount, 1,000 multiplied by the $60, the price, right? And the cost of goods sold, we already calculated, right? Which contain two components, right? The components that we made and sold of 800 units in December, and also the ones that that have been left from November, which has 200 units, right? And now we calculate the gross profit, and then we take the S&A from the gross profit. So now the operating income is 550, which is so much lower than the 3,000 that we calculated in October, right? So as you can imagine, the reason why we have a much lower operating income is because the cost of goods sold is much higher. right? If we just look at the 800 that we sold, the unit production cost is 48, right? So it has a higher, much higher unit production cost. And for some detailed reason, I will show you later. But if we calculate the operating income under the variable costing, everything stays the same because the cost of goods sold will be the same. So if we calculate the operating income under variable costing, it's still going to be 3,750. Right, so the conclusion is that if we made less than we sold, the operating income under the absorption costing will be less than the one in variable costing. So now let's put what we calculated in this table so that we can do a holistic comparison. Right, so the conclusion, I will not repeat again, but so how do you interpret this, right? So first, the reason why the operating income under the variable costing in different situations are the same is because we always sell the same amount of units, okay? And the unit production cost under the variable costing is always 23. They stay the same, right? Because the fixed overhead cost will not affect the unit production cost under the variable costing. But it matters to the absorption costing. And we observe that when we make more than we sold, the operating income is the highest. So here, I'm going to say something about managers' incentive. So let's say you need to, because the absorption costing is for the external users, right? You want to show people that you are making profits, right? So if you are the manager, do you want to make more than you sell or make less than you sell or equal? So if you are the manager, right? And now you are reporting according to GAAP under the absorption costing to show people your operating income. So do you have the incentive to make less than you produce or more than you produce? More, because under the second situation where you make more than you sell, right? You will have the largest operating income. This can be problematic because if the manager just want to, please the investors, right? So they will just make as many products as possible to have a less unit production cost so that the operating income can be bigger, which could be not good for the operation, right? So as accountants, right? Also now you know how the operating income will be impacted by different, mechanism inside. So we will be more So when we read the financial statement, right? You will know the tricks inside, right? It doesn't mean that this time you have a greater operating income means that you are actually doing a good job, right? Maybe the higher operating income is caused by some, the tricks chosen by the managers, right? So now you can see how the different methods can impact, and different situations can impact on the operating income. And that's why, as managers, right? So you can fool the outsiders, but you are the manager of your own firm, right? So you need to be honest to yourself. So that's why the variable costing can help, because under different scenarios, the operating income under the variable costing is still the same, right? So that's another reason why the managers keep a version of the variable costing operating income to themselves so that they know what's really going on in the firm, right? And also, I want to mention that, so we talked about the fact that part of the fixed overhead is being capitalized in the ending balance when we make more than we sell, right? What about when we make less than we sold? So in this situation, we actually subtract more fixed overhead than the fixed overhead incurred in this month because remember in December, right, we sold all the 800 units that we made, which already contains all the fixed overhead incurred in December. And we also subtract the cost of goods sold of the 200 units from November, which contains the fixed overhead cost in November, right? So here we say that so the cost of goods sold contains more than 100% of December's fixed overhead cost. Okay, so the correct answer is A. I don't know why the summary is not showing up. So who chose A? Oh, not many of you. So let me. Why?
Hey yo.
So the reason, right? So maybe you chose B, right? Why, Manila? Why it's so funny? Okay, so for B, right? So we said that part of the fixed overhead has been capitalized in November when we produce more than we sell, and that's when the part of the fixed overhead has been left in the ending balance, and we call it capitalized, right? And in December, not only do we deduct all the fixed overhead incurred in December, we also subtract part of the fixed overhead from November, which is the beginning balance, right? So we say that some fixed overhead was expensed on December's income statement, and that part of some November's overhead, right? So that's why we chose A. Okay. So any other questions related to this one? Okay. So here, this table is comparing the value of the ending balance under different conditions, right? So in October, when we made the same amount as we sold, we do not have any ending balance, right? So the value is just 0. And in November, because we produced 1,250 and we sold 1,000, right? So we have 250 units left. And the value under different costing system is just, so the difference is just that we need to multiply the 250 by the corresponding unit production cost under each costing system, right? And in December, because the ending balance is actually left from November, right? Because if we follow the FIFO, right? So the 50 units left is still from November. So here we still use the cost information from November. So the cost information says that under the absorption costing, the unit production cost is 39. Whereas under variable costing, it is 23. Right? So that's this is another tricky question, right? So it's asking why is December operating income less under absorption costing than, I think it's asking the same thing. So for people who chose A, I guess you just didn't read through the question. Right? So you know that the November fixed overhead becomes part of the cost of goods sold, but you didn't read that it's under variable costing, right? It's not under variable costing. Under variable costing, it's nothing to do with the fixed overhead, right? So it's being expensed under the absorption costing, right? So that's B is correct. Okay, so I already mentioned that, so if we use the absorption costing, the managers will have the incentive to produce more than they sell, right? Because that will give them the highest amount of operating income under the absorption costing, right? So if that's the case, we need to think of some rewarding mechanism that's not related to the absorption costing, because if we just reward the managers by the operating income shown on the traditional income statement, that will give them this incentive, right, to produce more than they sell. So we need to, reward the managers by, let's say, variable costing, because that will give you the same amount of operating income under different scenarios. And also the variable costing is just looking at the variable part of the manufacturing cost, right? And the variable part is considered as controllable within a short term. So that can help the managers better understand the manufacturing cost for the part that they can control, right? Because for some fixed overhead, for example, the rent, that's not something that they can control within a short term, right? So that's considered as sunk cost, right? And also the general rule is that for the incentive is that we are what we are rewarded to be, right? So this is very insightful, I found. For example, if I will not give you, credits on the attendance, I guess only half of you want to show up in the class, right? Because I reward you by coming to class, you have the incentive to come to my class, right? So that's a very simple example of this, what we are rewarded to be. And here are some managerial decision guidance or rules. So as managers, we are faced with decisions to set the price of the product, to control the costs, to plan the production amount, and to analyze the profitability of the firm. And sometimes we need to analyze the contribution margin, right? So now we learn the absorption costing and the variable costing, right? So now we need to understand how to use the two costing systems to help managers make managerial decisions, right? So the rule of thumb is that if we are making long-term decisions, okay, let's say you are setting the price for the next year, okay? And then you may consider using the absorption costing, because under absorption costing, the fixed overhead is considered as part of the production cost. And if you are pricing for the short term, you may consider just variable costing, because in the short term, the fixed overhead is not controllable, right? So you just want to cover the variable part. And we have the same rule for different decision making, right? So if you are making a long-term decision, let's say you want to control the costs for the next 2 years, right? So in this case, some fixed overhead costs, for example, the rent, can be controlled by you, right? Because you may need to sign a new contract, and that will impact on your fixed overhead, right? So if you are making the long-term cost control, you may consider using the cost information from the absorption costing system. But you are but if you are controlling costs in the short term, let's say in this month, you may just consider using a variable costing because you just want to control the variable cost, right, within the short term. And others are the same, right? And for the analysis of the profitability about the sales mix, we are going to talk about it in the following chapters. So you do not need to worry about that too much.